If you're watching this video, it means you've done some research around whole life insurance and you're likely interested in maximizing the cash value, which is my favorite thing to talk about with whole life insurance. So this video is meant to do a few things. Number one, it's meant to provide you with a basic understanding of whole life insurance, and I'm going to go over some of the most important things specifically regarding the cash value. Number one, I'll go through what to do versus what not to do, making sure that when you start your policy, it's truly set up for maximum cash value and you don't find out after the fact something could have been done better. This happens way too much in the industry. Number two, we'll go over commissions a little bit and exactly how that works to help with your understanding so you know exactly how we as agents are incentivized when we are setting up life insurance policies for you. And then I'll go through some other things such as how policy loans work and then really who uses whole life insurance successfully. When you look at models of people that have had whole life insurance for a long time, cash value's been their goal. If we see a model that works very, very well, whether it be an individual or a corporation using whole life insurance, we can learn a lot from that. So we'll discuss that. I'll describe exactly what our company, IBC Global, does. And then the purpose of this video is to help you decide if our company is a fit for you or not. So with that said, let's get on into it and have some fun talking about cash value life insurance. So what do we do? What does our company, IBC Global, do? We primarily offer whole life insurance where the goal is maximizing cash value. About 99.9% of people we work with will express that they're interested in whole life insurance for the cash value benefits. It's very common for us to hear someone say, I don't really care about the death benefit at all, or I don't care about it right now, the cash value is my priority. Very common to hear that. So some things we'll cover. Number one, whole life insurance and the industry. This way you can understand the culture of the life insurance industry and then see whole life insurance where the cash value is maximized, and you'll see a big difference as opposed to what goes on in the life insurance industry, meaning how us as agents, we as agents are trained compared to what you as a potential consumer is offered. This way you've got transparency into the industry and then also what you want to know in terms of how that policy should be set up for you. Why people are interested in it. So why are people interested in whole life insurance? The cash value. This is the big thing. How to maximize it and how to use it. Specifically, once you've got money in your policy, how can you use it? And this is typically through policy loans. We'll go through some examples of this. And then really the purpose here is to help you decide if whole life insurance is a fit for you, and also if we're a fit for you, if our company is a fit for you, if you like our approach, if you like our style, if we like you, we want to make sure that this relationship works indefinitely. Because if you have a policy, the plan is to have it for your whole life so you can use it forever, and we want to make sure we're always available to help you and you're comfortable working with us. That's very important. So the life insurance industry, how we found a niche in this space. So where I want to start here is really with a little bit of my story. When I first got into the life insurance industry, it was 2011. I worked in sales initially and I failed miserably. The first 3 years, I barely made $20,000, and that's not $20,000 per year. That's the total gross income I made over the first 3 years. First year I made was $5,500. Second year is $8,000. Third year is $8,500. I almost failed out of the business. There was one evening, I remember I was driving and I had a text message typed to my friend. It was typed out to try and pick up some work because he had owned a business. If I would have hit send, this company likely would never have started. But I'm glad I didn't hit send looking back at that time. So as the years passed, as I struggled with sales, I was able to gain experience at two firms. One was an individual planning firm where initially my role was a sales role, but I gravitated toward the illustration software. So my role was designing illustrations, preparing a lot of the financial models for the owner of that firm and also other agents. I was able to gain a lot of experience as far as the behind the scenes activity is concerned, building policies, understanding how to maximize the cash value. And then after that, I transitioned into a role at an executive benefits planning firm. That's really where I learned a lot of the ins and outs. My specific role there was designing policies. I spent the majority of my time in the illustration software, and we designed policies for corporations. So the owner of this firm would solicit business. He would work with large companies, and he would say, Steve, here's what we've got going on. I would run different illustrations, different models. We would speak with individuals high up at home offices. I remember one individual at a major mutual company. He was sharing with us how the formulas in the illustration software were actually written and how dividends were applied to different pieces of the policy, base premium, PUAs, very, very technical stuff. But it helped me really understand the mechanics and inner workings of whole life insurance when it comes to maximizing the cash value. And the thing I really appreciated about that firm is there is a lot of emphasis put on actual policy performance, not just illustrations, but actual results. As we progress through this video, what you'll see is when it comes to whole life insurance, there's a common theme, or there's a big problem in the industry. And what it is often people take out a whole life insurance policy based on what they see on an illustration. You're putting in X amount of dollars forever, and 20 years from now, the illustration says that you'll have $1 million. But then after 20 years, you were expecting to have $1 million. Did you? No, you've got $600,000, significantly less than what was illustrated. And you did everything according to plan. Do you have a good taste in your mouth when it comes to whole life insurance? Probably not. Most people don't in a situation like that. So that's a big issue in the industry, and learning what causes it and really how to prevent it to the greatest degree, what companies to use, what products to use, how to design those products. That's really what I appreciate the most about working at that firm, because we're able to see the model that worked and what corporations use when it comes to cash value life insurance, and then really just apply that to everyone we work with. So I learned how corporations set up whole life insurance policies where cash value was the goal. The cash value was an asset on their balance sheet. I got to gain firsthand experience in designing policies for corporations. And I really saw how the cash value was maximized for corporations. But here's the thing. The products we were using for corporations were the exact same products that an individual could attain. Meaning it's the same product you or I could purchase. But there's a big, big difference into how that policy was being sold to an individual compared to a corporation. So this was extremely valuable information, and it was great insight for me to have just as I continued to work at that firm. Because what happened toward the end of my time at the executive benefits planning firm, I connected with some marketing partners out in the Midwest. This was between 2013 and 2014, and they gave me a ton of people to talk to. And what I did, just one at a time, was speak to the individuals they referred, or these leads. They were sending me leads, and I would just show individuals exactly what corporations do. An individual would say, hey, I'm interested in whole life insurance. Cash value is my goal. I want to fund a policy with $15,000 per year. I would say, okay, with $15,000 per year going in, here's exactly what I would do. We would pull up the illustration software. We would build the policy together. This way they could see firsthand what to do and what not to do. And really all I was doing was just going over exactly what corporations do so they could see exactly that. And then we applied it for them as an individual. And I got to do that several thousand times as the years passed, just picking up a lot of experience. So I knew what to do in terms of designing policies, but over the years, I gained a lot of experience in communicating it to people effectively. That did help me quite a bit. And then in 2015, I started IBC Global. That's when we officially incorporated it, and it started in my father's commercial garage. So this was a commercial garage where on the side, about 20 to 25% of the building held two small offices. It was one office with a half a wall to divide two desks, and that's how I started. It was me and one part-time assistant. As we continued to grow it, we were able to hire more people. Eventually, we renovated that garage into a full commercial office, which looked really, really nice. But then as time passed, we actually renovated it again and turned it into a recording studio, as that's the primary purpose for it now. But going back to 2015, if you see some pictures, that was it was an old garage. It did not look like a financial firm or insurance outlet by any means, but it did get the job done, and that's how I look at it looking back. So today, we do make it a point to go against the industry norm. And what I mean when I say that is our goal is to maximize consumer value. And what I mean when I say that is maximizing the cash value in a whole life insurance policy instead of the agent commission. And I'll add this can be a win-win for both the consumer and the agent if it's done right and there's a long-term relationship there, which if the policy is set up for high cash value, you, the policyholder, are going to keep that policy for a long period of time. You're not going to lapse it or cancel it because you don't see the benefits there. Typically, if it's maximized, the benefits are there. And then as a result, the agent does receive renewal commissions over time. That's where it can be a win-win. So an agent does have to have a long-term mindset in order to make this model work, because what you'll see is if you maximize the cash value for an individual, so if I maximize the cash value for you as a policyholder, my commission upfront will be minimized. However, as time passes, that commission will snowball. So that times a lot of policies, it does add up over time. But it can be a win-win, and I want to make sure I mention that. But our goal is, again, to maximize consumer value and not agent commission, and then prioritize sales over service. This is very, very important, where the industry does put a big priority on new sales, where we don't want to do that. If someone gets a policy and they've got a question, we want to make sure that we're available to answer that question. If we can't answer it, we want to do the research in order to provide a proper answer instead of just referring them to a customer service center or something like that. That usually just creates more confusion. So let's talk about the life insurance industry a little bit, and this will be specific to whole life insurance because there's a lot of different types of life insurance products. When it comes to whole life insurance, the product can be confusing because there's a lot of information, and it can be hard for a lot of people to trust life insurance agents. If you were to look at data on some of the least trusted professionals just in sales, number one is used car salesman, and then number two is life insurance salesman. So it's difficult for a lot of people to trust life insurance agents. You may have felt like that just when you started to research whole life insurance. You may see the high cash value and such that's attractive to you, but then we hear all of these bad things. So trust is a very important thing. So if you said, well, I don't trust life insurance agents, or I don't trust anyone, I just want to know how to do this on my own. Let me figure it out on my own. This way I can make sure it's set up properly. There's enough information out there where you can learn how to set up a policy for maximum cash value. You still need an agent to ultimately sell that policy. But if I'm a consumer and I have the knowledge that I have being in the industry and I wanted a policy, I know exactly what I would say if I'm working with an agent. I would say, I want a policy with this company. Here's how much I want to pay in. I want it maximized for cash value. Here's the limits I want. I could give them that order, and then they could honor that order by setting it up that way. But that's because I've got the knowledge there. So anyone can attain that knowledge. The thing is, it'll take a long time. It took me a long time, and that's me doing it for a living. Another issue with that is that the industry does prioritize new sales over service. So if you're doing the research and you're asking for a policy to be set up in a certain way, because the industry is prioritizing new sales, a lot of times you'll get resistance around educating on how the product works or setting it up for minimum commission, because that's not the focus, or call it the culture, of the life insurance industry. And then here, if you have problems with your policy, usually what happens is you're directed to a customer service rep. You can't get in touch with your agent. Your agent is no longer in the business, because when you look at individuals that get in the life insurance industry, if you were to take 100 new licensed agents, how many do you think survive? Meaning they actually make a career in the life insurance and financial services industry. It's about 8 out of 10. Very, very low percentage. So that can make it difficult for you as a policyholder to get your policy serviced. Or if you have questions, having those questions answered. If you have an issue getting policy loans, whatever it might be. And then what happens is we are deferred to a customer service rep who is not familiar with how the policy was set up, and it can cause a lot of problems, a ton of frustration. It's not something we want at all. When we really started building the business, that was a focus of mine. And in the beginning, there are so many late nights just working on clients' problems or policy problems to make sure they were resolved properly. Because the insurance company or customer service might say one thing that's not 100% accurate. And we're like, no, we've got to make sure that the policy is set up correctly or this issue is resolved for the individual. One, from an immediate standpoint, but two, long term. We don't want the policy to be messed up. Like, that's important. I would want that if it's me. So, IBC Global, what do we do? I mentioned this earlier. We sell whole life insurance with the goal of maximizing your cash value. How to maximize it, and then how to use it. Here's our approach. The number one rule, and this applies to you, everyone we work with, and our employees, is treat others how we want to be treated. There's a rule that's called, you might know what I'm talking about, but that has helped me personally in my personal life. It's helped tremendously in business. That's always the number one thing when we are approaching any situation. How would I want to be treated in this particular case? Number two, make whole life insurance transparent and also understandable. Number three, build a business that's driven by education and customer service. This is very, very important to me. When it comes to business and sales, I've never naturally been good at sales. I've never asked for a check or tried to hard close someone. It's just not my style. My big thing is provide the education, show individuals how it works, and if they want to move forward, show them how they can do it, and then we are here to help you all along the way, with service, that is. And then we've got this piece, offer the best insurance companies and products to everyone. This is very, very important because there's a lot of life insurance companies out there, but there are certain companies that have a track record of delivering the strongest cash values to policyholders. You'll see these companies used by big banks, corporations, wealthy individuals, because they've got a reputation of actually delivering strong results, not just illustrating or projecting good-looking results. And then solve the commission problem in the industry, which is, again, focusing on service, not new sales, and setting up policies for very, very high commissions. We'll talk about that more later. So building a business that's driven by education and customer service. Number one, we mentioned this already, make whole life insurance transparent through education. That is so important. Teach every client how to use their policy. This is upfront and it's also ongoing. Always be willing to provide top service to our clients. The key word there is willing. If you've got a question, we'll be willing to help, even if you feel like you're asking the same question over and over again. I'll add something here. When I'm purchasing a product or service from someone and I'm brand new to it, meaning it's a product I have zero exposure to or a service I don't understand at all, I never want to feel like I'm annoying the salesperson or the service person by asking the same question time and time again, trying to understand it. And when I speak to a business owner or someone in sales that's very, very good, what I've noticed is they're very, very patient. They'll always listen to me, answer my questions as many times as needed. And that has always gone a long way with me. So I want to make sure we're always doing that for everyone else. So if you have questions, even if you feel like you're asking a million times, ask away. We'll answer them. We also have a lot of video resources in which we can provide education that way and answers that way. So how we provide service or how we build our business through education and customer service is through video education. We also have one-on-one meetings, and then you have a team of people that is assigned to you. So let's get into whole life insurance and maximizing the cash value a little bit. How is your whole life insurance policy set up? And again, this is assuming your goal is to maximize cash value. This is the most important piece by far. Where buyer's remorse comes into play is if someone purchases a whole life insurance policy where they say cash value is my goal, they are led to believe that the policy is set up for maximum cash value, and then they find out after the fact that it's not. So a model that you can copy is the wealthy, because they get it right. So what's their secret? Like, what do wealthy individuals do, and even banks and corporations for that matter? So when it comes to wealthy individuals and families, they often have advisors who have experience with whole life insurance. They've seen whole life insurance, and they know how it should be set up. I'll give you a personal experience in this. In 2021, early 2021, I met a couple that does extremely well in business. They are wealthy. They are looking to open whole life insurance policies and fund them with 7 figures per year. So we had the first meeting, went great. We liked each other, like, all right, let's start a policy and such. I get a text from the husband, and he says, meeting was great. However, I'd like you to meet my estate planning attorney. She's one of the few people I trust with all of my money. He was just going through his normal process as far as qualifying people. And I'm like, sure, no problem. So we have a 3-way call. It's with the couple and the estate planning attorney. And she knew her stuff. She was very, very good at what she did with respect to her knowledge level, but also how she communicates, and she asks questions, many of which she knows the answers to already. Really, she's aiming to see how I answer those questions and if I know my stuff with whole life insurance. But that meeting started out, she was very, I don't want to use the word aggressive, but she was very intentional in making sure that any product her clients were going to purchase was truly set up in their best interest. So she's asking me very specific questions with respect to the design, commissions, company selection, product selection, how tax limits work with the policy, very, very in-depth stuff. And to make a long story short, they ended up moving forward with the policy, the couple that is. I ended up hiring that attorney because I was so impressed with her and her firm from that meeting, had several meetings afterwards, and now they help us with our business and personal planning. But my point is, this wealthy family had an advisor that was very, very good at what she did, and they used this advisor to qualify me. So in this case, they had an advisor that could vet me. The thing is, not everyone has an advisor, and her hourly rate is right around $1,000, so about $1,000 per hour. So that's not something everyone is going to do. But we can look at the policy that the wealthy couple has and copy that same model. This way we know things are set up correctly. Another great example is banks. So banks often own a ton of cash value life insurance. A lot of banks own as much as they legally can. But the thing with banks is before they purchase a policy, what's referred to as a pre-purchase analysis has to be done. So before a policy can be sold, a very in-depth analysis needs to be done for the bank first. This is every time they purchase a policy. There's a third-party administrator involved that does a lot of due diligence to share an experience in working with a bank. So our largest client as a firm right now is a bank. They are a community bank. They are between $700 and $800 million in assets. So they're not a tiny bank, but they're not a mega bank like Bank of America or anything like that. But when I met with them, so we go to the boardroom, they're interested in a bank-owned life insurance policy. They had met with other agents. When I go to the boardroom, the owner of the bank is not in there. You've got the co-CEO, who's also the CFO. He's a numbers guy. You have another individual who was a former examiner, so very, very technical guy, has seen bank-owned life insurance owned by other banks. He has an understanding of the product. And then you have another individual in there who is a very, very good people person. He was very pointed with his questions, would often put pressure on you to see how you would answer and such. So we're in the boardroom. We've got my sister-in-law there, Dara, who's our director of operations now. And just seeing how they vet, one, who they're working with, but more importantly, the product. They're making sure this product is truly set up in their best interest. The reason why is because they want to make sure it's set up for maximum cash value. And what happens is if you maximize the cash value, what happens to the agent commission? It is minimized. So they know what questions to ask. They know the rules of the game, if you want to call it that. So we've got a model that works with the wealthy, with banks and corporations, and really copying that model can ensure that we succeed. So how should a policy be set up? Number one, maximum cash value. Number two, minimize the premium. And just know that if you minimize the premium, the commission will be minimized to the agent. That is going to happen every single time. It's common for some agents to get very defensive here, which I understand because it can be viewed as their livelihood. Here's my mindset on it. I have zero issue with an agent making money on a life insurance sale. That's how we make money as a company. However, if I'm a policyholder or a potential policyholder, say you're an agent, and I come to you and explicitly state I'm interested in this policy for the cash value. I want the cash value maximized, and then I want to use my cash value for business, real estate, retirement income, whatever it might be, but maximize my cash value. That's what I'm interested in. I say that to you, and you're the agent. Then you sell me a policy. You lead me to believe that it's maximized for cash value, but it's not. It could be set up for more cash value up front. Long term, it could be better with the exact same company and product, but you make more money. I find out a couple years later. How am I going to feel about you? Not that good. So that's where an issue can really occur here. Just remember that it is your money. So here's a question that comes up quite a bit, and I just want to hit on this because it is very, very important. What life insurance company should I choose? Because there's a lot of them out there, and you don't need me to tell you that. What I would go with is a company that can provide strong, actual performance. And I'm not referring to dividend history here. I mean proof of performance, a real policy that has lived the test of time, and we see strong actual results, not just projected results. So don't just tell me you're a good company. Don't just tell me you've been around for over 100 years. Don't just tell me here's my dividend history. No, show me a real policy that has lived the test of time. And we ask companies this before we offer them or recommend them to individuals. Before I put my money into a company, I want to see this proof. And sometimes, or it's in many times, they get annoyed with me, which I understand it, but at the same time, like, this is important. It's people's money, and if you're interested in the cash value, we want to make sure that it's maximized and we've got proof of performance. So we've seen 4 companies provide proof of performance. We have data on this. If you'd like it, let us know. You'll also see it on our YouTube channel too. We've got our 4 major mutual companies, which are Mass Mutual, Guardian, New York Life, and Northwestern Mutual in no particular order. I'll say our company primarily uses Mass Mutual and Guardian for individuals. We use New York Life with bank-owned life insurance in addition to Mass and Guardian. Why we primarily use Mass and Guardian, there's 2 reasons. One, they work very, very well with brokers. We're independent brokers. We're not tied to any particular insurance company. Mass and Guardian work well with brokers. But then 2, they're very flexible. Flexible in the sense that you can adjust the dollar amount you pay into policies over time. And we'll talk about that more as we get into the specifics. New York Life, we can use as brokers, just as we look at them and individuals compare everything. They don't always make sense. Sometimes they do. And then Northwestern Mutual, we actually cannot use. They only work with their career agent sales force. Why we mention them is because I've seen too much concrete proof of them being a solid company delivering strong actual results. I can't say that Tom Brady is not one of the best quarterbacks of all time, or some would say the best. Like, I can't say that. No, regardless if I don't like him or if I like him, whatever it might be. Northwestern Mutual has that track record. So my big thing is for major mutuals, we've seen them deliver. If I'm ever speaking with someone that's not working with our company, I'm going to say make sure you consider at least one of those 4 companies and then make sure the policy is set up correctly, which we'll get into. And here's an important piece. In our experience, when we look at commission rates and such, when you look at the major mutual companies with a policy that's set up with a minimum premium, meaning it's maximized for cash value and the commission's minimized, you'll typically see the major mutuals pay between 30 and 40% less in commission than smaller companies. And this is assuming all things are equal. So I'm an agent, I'm looking at one of the major mutuals or a smaller company. I'd be paid 30 to 40% more with a smaller company with the exact same setup. Smaller companies often will pay more. And not that there's anything wrong with that, but it is important to be aware of just from an incentive standpoint. I'm incentivized to use smaller companies instead of the major mutuals. And I would say this, if all things are equal, meaning I see smaller companies delivering the same consumer value as the major mutuals, like I see that strong cash value over time, I would have zero issue with that. So I do like to mention that because a lot of people are surprised when they see that figure. So another question here, how do I fund my policy? Do I just pay a premium every year? No. Here's the fun part. A policy can be very, very flexible. It doesn't have to be a boring bill. There's generally 2 ways you can set up a policy with respect to funding it. Number 1, it can be fixed funding. So fixed funding means you're just scheduling a dollar amount and you pay the same amount of money every month or every year. Now that fixed amount typically can be adjusted if we do everything properly on our end as the agent, but a fixed amount means you said, I want to pay $500 per month or $5,000 per month, and I just want to set it and forget it. We'd say, okay, you can do that. Of your money going into the policy, of that $5,000 per month, we're going to set the premium at $500 per month and have the rest go toward riders that maximize the cash value. This way, you're scheduling the dollar amount, but it's still optimized for cash value. So number 1 is fixed funding. Number 2, my personal favorite, flexible funding. So with flexible funding, you can commit to a low dollar amount and then add more money to the policy at your leisure, which is nice. This prevents one from feeling like they're stuck with a boring payment plan. An example of this, let's assume you said, I'd like to be able to fund up to $100,000 per year. I want to be able to slug a lot of cash into this policy. But I'm hesitant to move forward because I don't want to bill for $100,000 per year. Well, what you can do is set that policy up where you're only committed to $10,000 per year and then add up to $100,000 at your discretion. You don't have to. You're not penalized if you don't. You can make it very, very flexible. And the same is true if your high-end number is $20,000. I can go up to $20,000, but I'm only committed to $2,000. So I can really squeeze the minimum commitment down to a very, very low number, which makes the policy not feel like a burden. It's a number that, hey, I could do that in my sleep. That's often what we want to do. This way I can continue to use the policy to the fullest degree and not have any stress because of this big bill. So let's go through the cash value here. And I want to hit on the core benefits. So if you were to ask, why do people do this? Or what's so great about the cash value where people want to put money into whole life insurance? Because everyone we work with, when they approach us, they want the policy. We're not selling them or trying to convince them to do it. It's here's the benefits, and someone says, I want it. So again, this is why someone's interested in the policy. And here we go. Number 1, it's a safe area to position money. Second, it's liquid. And then 3, it is tax-free. So those would be the 3 core benefits that I would write down: safe, liquid, and tax-free. Let's go through safe, a little bit of information here. So it is safe in the sense that the net growth rate will continue to appreciate over time. Here we've got 3 to 5% as far as what we might see the cash value grow by. Historically, it has done better than this. We've got policies that have done right around 6% or a little bit stronger. But with that said, just with interest rates and dividend rates still being low right now, I'd much rather set expectations lower as opposed to tell you 6% or higher and then it only does 4%. That usually causes a problem. Now, that 3 to 5% or any growth rate on a policy, it must be properly designed, and we would recommend a major mutual company because we've seen proof of performance. We're not just hoping that things work out. Now, with a safety, your cash value continues to compound over time. So let's say you've got a policy and the average growth rate is 4% over time. That will continue to compound, meaning we'll see it continue to go up regardless of poor economic conditions or poor stock market conditions. In 2008, a lot of interest was drawn to whole life insurance for the cash value because people were looking for a safe area to position money. I remember hearing a story, this was in 2012, where someone was talking about his whole life insurance policy. He said, man, my whole life insurance policy in 2008, it just kept going up. Like I didn't have to worry about it like I would worry about other assets or investments that I have. So you do have that peace of mind with respect to the safety of a policy, and that's why a lot of people are interested in it. Number 2, liquid. So with the liquidity, how liquid is your policy? Well, you can access it anytime. The cash value continues to compound when you access it, specifically through policy loans. A unique feature to policy loans, or the cash value, I should say, is that once a dollar passes through the cash value of your policy, regardless if you just let it sit and grow and say earn that 4% we talked about before, or if you borrow against it, you continue to earn that 4% on the entire cash value. Money in remaining equity and what's loaned against the policy. We'll go through an example of that a little bit later. With respect to accessing the money, how convenient or easy is it? It's very, very easy. You can typically access your funds through an online portal, a mobile app, or this could be our office, and it's usually done direct deposit in 3 to 5 business days. Then we've got tax-free. So this piece is appealing to everyone. Who doesn't like the word tax-free? So we've got here the cash value can be accessed tax-free, and it's easy to do. However, taxes can occur, and I always like to mention this because life insurance is frequently marketed as tax-free, tax-free, tax-free because it can be accessed tax-free. However, it's possible to mess it up, and then I have to deal with a tax bill, and if I was just told it's tax-free and then I've got taxes, that could result in a problem, couldn't it? Yes, it definitely could. So it's tax-free, but taxes can occur if the policy is not set up correctly. What I mean when I say that is 1, the policy becomes a MEC. MEC stands for Modified Endowment Contract. We'll talk about that a little bit later. If the policy is cashed out or it lapses and there's a gain on it, the gains are taxable and they're taxable as ordinary income. These are 2 examples. We like to go through the different examples and items that could trigger a taxable event. It's always easy to prevent. We always monitor policies on our side, but still we like to provide just enough awareness so someone's not misinformed on the product. It's important. So what are you getting with the cash value? Here's some bullet points. Number 1, this is what you're getting with a whole life insurance policy where cash value is your goal. Number 1 is no risk. Your money is not invested in or tied to the stock market at all. You've got a guaranteed minimum interest rate on your policy. You'll typically see guaranteed rates range between 2 to 4%. If you have a whole life insurance policy and you started it between 1980 and 2021, it has a guaranteed rate of 4%, most likely. If you started it after 2021, it has a guaranteed rate anywhere between 2 and 3.75%. The guaranteed rate is the minimum rate assuming no dividends are applied to your policy. You'll see with most dividend-paying life insurance companies, especially mutual companies, a dividend is typically paid. If you look at the major mutual companies for 2023, dividend rates are between 5 and 6% right now. They adjust year to year. Sometimes they stay the same, but we'll see dividend adjustments occur one time per year. The net IRR represents internal rate of return. We can refer to this as the growth rate. Will typically fall somewhere between 3 to 5% over the life of the policy. In the first year will always be negative, which we'll look at a specific example on that. But as time passes, what can I expect in terms of cash value performance? Somewhere between that 3 to 5% range. And remember, when we couple that with the tax-free piece, and also that it's compounding when we can access it, that's what becomes attractive to a lot of people. Very similar to appreciating real estate that I can access. Flexible funding, so I'm not committed to a boring bill. I can adjust the dollar amount I add to the policy as time passes. Whole life insurance does not mean that you need to pay premiums for your whole life. You do not have to do that. It's very common for individuals to fund a policy for 2 or 3 years. Maybe they've got a lump sum and they're getting it into a policy over a short period of time. Very common to see that. Premium payments are generally not tax deductible. Even if you own a business, typically we cannot deduct it because if we want access to the cash value, if we deduct the premium and the full amount we're paying into a policy, technically it's going to function more like a qualified account. But if you've got questions on that, if you own a business and such, we can talk about how people do use policies within their business. It's very, very common, and there's a lot of cool things you can do. The cash value technically does grow tax deferred. However, it can be accessed completely tax-free if done so correctly. And then we've got no lost opportunity cost. That specifically has to do with accessing your cash value through loans. It works a lot like a personal line of credit. If you've got $100,000 in cash value, it's compounding at 4%. I borrow $50,000. I have a cost to borrow on the $50,000 I loan. However, I'm still compounding at 4% on the full $100,000. We will look at an example soon. Here we've got some dividend history with 2 of the 4 major mutual companies, and this is the total dividend interest rate. So for example, if I look at Guardian on the left, 2023, the dividend rate is 5.75%. Okay. The guaranteed rate on a product might be 3%. The dividend rate includes the guaranteed rate. So it's not the guaranteed rate plus the dividend. The total dividend interest rate applied to my policy would be 5.75%. And a very, very important piece to mention here is whenever we see dividend rates, that's a gross rate. You might recall on the last slide, we had dividend rates between 5 and 6%, but the net internal rate of return was between 3 and 5%. So a dividend rate is never what our cash value will actually grow by. Meaning if I've got $100,000 in cash value and I have, call it a 6% dividend, like I see here with Mass Mutual, 6% of $100,000 is $6,000. Would I see $6,000 in growth? No, I would not, because the dividend is a gross rate. 6% actually means 4.5%. It depends on what year I'm looking at. But the net growth rate or the internal rate of return provides transparency on what's the exact rate that my money's actually growing by. For example, if I'm at 100 and the next year it's 105, then we would see the net growth rate at 5% that year. So setting up policies like these guys, this is important. Banks, corporations, and wealthy individuals. Banks, we won't spend a whole lot of time on this, but it is interesting information. So with a bank, when they purchase bank-owned life insurance, how they approach the cash value is like this. It is a tier 1 asset on their balance sheet. Tier 1 means it's some of the safest capital or the safest capital. An example, Bank of America, they've got over $20 billion in cash value, well over $20 billion actually. Banks will often buy as much as they possibly can. The smaller community bank we mentioned earlier, they're near the maximum limit of bank-owned life insurance they can buy, because there are regulations that limit how much life insurance can be purchased even with one particular company, but they're just about at that limit because they like positioning it on their balance sheet, which tells us something. If they're doing that, there has to be something right about it. Like, they wouldn't just throw money away. Corporations. And this also applies to small businesses. So typically how this model works is a company or corporation will open policies on their executives. The corporation owns the policy, funds the policy, and is also the beneficiary. Now, the corporation will pay a retirement benefit. It's almost like a pension. There's a lot of similarities to the executive if that executive meets the vesting requirement. So for example, let's say I work for you. You own a corporation and you say, Steve, I'd like you to stay with my company until you retire. So if you stay with me until retirement, I'm going to pay you a retirement benefit of $100,000 per year. I say, okay, sounds great. What's the catch? Well, you say, you have to stay with me. If you don't stay with me, you're not, for that vesting requirement, that is, until retirement, because that's what you include in the terms. If you don't do that, you don't get that $100,000 per year. So it creates golden handcuffs for me. So I feel like I have to stay at the company if I want to receive that retirement benefit. Now, how you fund that benefit is through cash value life insurance. So you take a life insurance policy out on me. What that provides immediately is key man insurance for you. So if you're taking this policy out on me, it's likely because I'm producing for you and you want me to stay with the company this long. So if anything does happen, you've got a tax-free benefit that flows back to the company. So it goes income tax-free to you because you are the beneficiary. Now, you also own the policy. So as you fund it, it builds cash value that's an asset on your company's balance sheet. You have control. You can take loans just like an individual could. The one thing you want to make sure is that when it comes time for that retirement benefit, you've got sufficient cash value in there to be able to pay me that benefit, because you do draw up a legal contract. There's typically lawyers and such involved in this process that make sure everyone's treated fairly here. So you're promising me a benefit, so we just want to make sure we don't drain the cash value before then. But you do have control of it all the way through. So that's very appealing to corporations. They retain their top talent, then also reward them on the back end, and they've got this policy all the way through, which is nice. And again, if I don't meet that vesting requirement, what happens to the policy? You keep it. Meaning, if I, your executive, decide to leave anyway, and I say, keep your $100,000, I don't even want it. Like, okay, no problem there. You keep the policy. You could elect to transfer that policy to another executive, or you just keep it because the death benefit eventually is going to come back to you. And then, again, the cash value is an asset on your balance sheet, and you have access to it the entire time. Wealthy individuals. What attracts them? The core benefits of the cash value. Safe money, liquid money. The tax benefit is huge too. Because if I'm in a higher tax bracket and I see a 4% or even a 5% growth rate that's tax-free, how valuable is that? Or what would I have to earn in a taxable account with no risk to achieve that same 4 or 5% tax-free, risk-free? There's a big difference there. That's a big reason why a lot of people are attracted. They'll still put their money in other areas, but this is attractive to them for that reason. In addition to that, the cash value can be used for real estate and business opportunities. I'll get into more detail around this story a little bit later, but there are two business partners we work with. They own a pharmaceutical chain, and they fund policies with 7 figures annually. Now, why they do that is, one, for the safety, but 2, they are tired of working with banks, having to deal with the paperwork, delays, rates changing. They still work with banks, but they're like, we don't want to have to deal with this stuff anymore. So the mindset there was, let's aggressively fund this policy. We like the benefits here. And then we can use this as our own source of financing instead of having to rely on a lender or an institution, a bank, for example, because with a policy, very, very easy to access it. When we take out loans, it's termed a loan because it's tax-free, but we don't have to repay it. We can pay it back however we want. It's very, very flexible there. So that was very, very attractive to them. So you'll see a lot of wealthy individuals use the cash value for opportunities, whether it's business, real estate, whatever it might be. And then the death benefit is paid income tax-free, which does provide generational wealth. And it's very common here to see a trust or a series of trusts that are used. And the purpose of that is really to make sure the money stays within the family or entity. You'll see corporations do the same thing when they've got the legal agreements in place for the executive benefit plans, that is. All right, so a lot of info. Let's continue on here. We've got the right way and the wrong way. This is specific to setting up a whole life insurance policy. So we're going to go through what to do and then more importantly, what not to do. Here's a big, big problem in the life insurance industry. The wrong way is frequently presented as the right way of doing things. Meaning, I sell you a policy, I lead you to believe that it's set up for a maximum cash value, you buy it, and then find out that it's not. How do you feel afterwards? You don't have a good taste in your mouth about me, the life insurance company, the life insurance industry. It's not good. So how can you tell the difference? Let's start with what not to do. This is typically what I remember best when people are showing me, do this, don't do this. We'll start with don't do this. What we don't want to do, if we're interested in a policy for maximum cash value, is buy a traditional whole life insurance policy that just has a premium. An example, I sell you a $1 million whole life insurance policy that costs you $20,000 per year in premium. You pay that every year, but looking at the first year, you have nothing in cash value. It might be anywhere from 0 to 30% of the 20K that's actually in cash value, very, very low. As you pay that $20,000 every year, it takes 10 to 15 years just to get your money back. Meaning by year 10, you've paid in $200,000. If your total cash value is $180,000, you have not recaptured your money. So this is a great example of exactly what not to do. It's also an example of whole life insurance and how it is commonly sold in the industry. The majority of policies are sold like this. It's just a life insurance policy. Pay a premium, I get a policy, and by the way, you've got this cash value that builds up over time. So some tips on avoiding a bad policy or tips to avoid being sold a bad policy. Focus on your cash value. 80 to 90% in the first year is what I would look for, and that's of my total payment. Number two, if your questions are not answered, ask again. It's okay to ask your agent questions multiple times, whether you're working with us or anyone, until you have an understanding. Because remember, this is your money going into the policy. We want to make sure we really understand the product or avoid a bad policy. Make sure we're not being taken advantage of or overlooking something very important. And remember that it's your money, not the agent's. Let's look at an example of what not to do. So here we've got a 45-year-old individual, and you see it's entitled, Remember the Doctor. So I'll share a story about this. Early on in my career, this is when I'm working at the individual planning firm. I'm sitting in the conference room at my cubicle. A doctor has a meeting scheduled with a manager and the owner of that individual planning firm. The guy walks into the conference room. I'm watching this through the glass windows, throws a book on the table and says, I want to pay $100,000 per year into a whole life insurance policy. Now, granted, my eyes are like popping out of my head when I hear the details of the story because I'm making $8,000 for the entire year. I'm struggling and thinking about the life insurance business is not for me. So why he wanted to put $100,000 per year into a policy is because what he had read in the book was that a whole life insurance policy has a lot of cash value benefits, and that's what he wanted. The cash value is what he was interested in. However, he was sold a policy that was not maximized for cash value. What we see up on the screen is very similar to what he was sold. So Doc paid $100,000 per year into the policy. It was all premium, or just about all of it. He had zero in cash value in the first year. The actual product might have had a couple thousand in cash value, but it's not what he wanted. And when's his break-even point when we look at it? Year 14. When we look at the chart, what do you see in year 14? It's highlighted in yellow, but look at the column entitled Total Funding in black. 1.4 million. It's because he's paid $100,000 per year for 14 years. 100 times 14 is 1.4 million. And what's his cash value? Just over 1.4. The year before, he's paid in 1.3. What is it? Not 1.3, it's less. So the break-even point is the first year that your cash value is equal to or greater than your total payments. Next, what to do. So what should I do with a policy, or what should I look for? High cash value immediately. What that means, I should usually see somewhere between 80 and 90% of whatever my payment is in cash value in the first year. Some products will give you more than that. Some products, it'll be closer to 80%. As you learn more about different companies and products, you'll pick the one that you like the most, and the first year percentage will vary a little bit. Regardless of that first year percentage, I should see a positive cash value or a break-even point somewhere between 3 and 6 years. With doing it this way, I'll see stronger cash value growth, I'll see stronger guaranteed cash value, and usually stronger non-guaranteed cash values as well. But then I also have flexible premiums and a limited funding period. A really nice thing about setting up a policy the right way, in my opinion, the right way to do it, is if life happens. Let's say I plan on paying into a policy for 30 years, and I max funded, I'm cash rich right out of the gates. Life happens after 4 years. I lose my job or I get disabled, I can't pay anything. The policy will continue to perform at a high level because I max funded it in the early years. So the policy is very flexible, and I can also limit my funding period. I can fund it for a short period of time if life happens or if I just want to. I've got the ability to commit to a minimum premium and add more money at leisure. How I add more money is through what's called my paid up additions rider. This is my PUA rider. I like to refer to this as a cash dump-in. We'll talk about this in a little bit. So an example of what to do, what the doctor could have done here, but he was never shown this. This is a whole life insurance policy with the exact same company. Maximum cash value on day one. This particular example could even be a little bit stronger here, but he pays in $100,000. Instead of a 0, what's he have in the first year? Almost 89%. He's got more cash value long-term. The break-even occurs between years 3 and 6. In this specific example, he's very close in year 4, and year 5 he's positive. From the life insurance perspective, when we look at the life insurance death benefit, you will see less initially with a high cash value design. However, long-term, you'll usually see more. And the reason why is because when you look at a whole life insurance policy, in most cases, when you hit 100 years old on that illustration, you'll see the cash value and death benefit equal to each other. The cash value gradually gets closer and closer to the death benefit as time passes. So if I've got a policy that has the most cash value by the time I'm 100, and I'll usually see this come true in my 80s and 90s, but if I've got the most cash value long-term, I also have the most death benefit long-term, because I know that the cash value and death benefit will be equal at 100, so if the cash value is beefed up, naturally that death benefit will be higher long-term too. And the easiest thing to do is just compare different designs if you're curious about how that works. Now with this design, the agent does make a minimum commission up front. Don't worry, he still makes money over time. You're going to see exactly what you make with this policy. And then the policyholder has access to cash value for opportunities, premium flexibility, so he can commit to a small amount and add more at leisure. To provide some specific details on that, what he can do with this exact policy, while we see $100K going in, the minimum premium is $10,000. So with this policy, you could literally commit to $10K, might come out to 11 or 12,000 with the riders and everything, but he can commit to a very, very small amount and then just add excess funds whenever he wants. So I'm committed to a small amount with the ability to add more money at my discretion. Now it does not feel like a burden or a heavy bill. So the below illustrations are exactly what we just looked at. We've got option A in red entitled, I don't want this. And then we've got option B in blue, I want this. Which one would you want? And again, these are the exact same company. They're both whole life insurance products. If this is you, it's the same dollar amount going into the policy every year. That column on the far right, cash value difference, that shows how much more you have with this option entitled I want this compared to the option on the left. Out of pocket to you is identical. Significantly more cash value. And you can also look at the death benefit. The example to the left starts out with much, much more. A much higher death benefit, 5.1 compared to the 1.5. But as time passes, what happens? You'll see this toward the very bottom. The example to the right with more cash value also has more death benefit. Interesting stuff, isn't it? So our goal is to maximize cash value. People we work with are interested and generally have a basic understanding of the option to the right. That's what they should be looking for. So we're going to pull that example up again in a little bit and look at the commissions, but here's what I want to start with. So if you like the details here of a policy and you want to know what should it look like, or I want to understand how to maximize my cash value, here's the question I always like to ask. Where is your money going? When you look at an illustration or your policy, when you pay money into a policy, you'll see it can go toward one of two areas. Number one, it can go toward what is called the base premium. Base premium dollars generate very low cash value in the first year, typically zero, with traditional life insurance products. Some products give more upfront, but most whole life insurance policies, base premium dollars give zero or a small percentage of your payment to cash value. They purchase a death benefit up front. That's the first area. The second area is our PUA, that stands for Paid Up Additions rider. This gives you high cash value immediately. A PUA payment will typically give you 90 to 95% cash value in the first year. An example, you pay $10,000, you see $9,000 to $9,500 show up immediately. Here's a question. My dad asked me this early on in my career. One day I'm sitting at the couch. I lived at home. I'm playing around with the illustration software, and he's looking at it and he goes, can I just put all my money into the PUA rider if I don't care about the death benefit? I'm like, no, you can't quite do that, unfortunately. Then the follow-up question naturally is what? Well, how low can the base premium be? How low can you go, man? And we've got 10% here. So 10%, this is not a hard rule, but you'll see this 10% figure is really more of an average when we look at the major mutual companies. Some let us go a little bit lower. Some don't let us go as low as 10%. Sometimes it depends on the product and our age. If we look at smaller companies, some will let us go actually a little bit lower than 10%. Some force it to be higher. Generally, when we're setting up a policy for maximum cash value with the major mutuals, 10% is a good starting point to know we're very, very close to optimal performance. That's why I've got it here. And when we see 10%, 10% of what? 10% of the total amount you are depositing into the policy. What I mean when I say that. An example. Let's assume you want a policy and you're funding $10,000 per year. You've got your base premium at 10%, $1,000 per year. Your PUA rider is $9,000 per year. Question for you. Do you have to commit to $10,000 every year with this particular design? Nope. You can set it up to be flexible, where you're only committed to the 1,000, and then you can add additional PUAs at your discretion. You might not even hit $10,000 every year. By the way, if you hit only 1,000 for 3 years and then wanted to throw in 30 the next year to make up for lost time, you can do that too with a lot of companies and products. We call that a catch-up contribution, which is a ton of fun. But that's a good topic for another time. Now, I'll add this. With what we just talked about, again, it is common to receive resistance from agents about this. A lot of times what I heard when I was early on in my career, when I would bring this type of design to a manager I worked with or someone, they would say either A, you can't do that and just brush me off, or B, say, well, you don't want to do that. It's less commission to you, you know. I'm like, all right, I get that, but if it maximizes the cash value and that's what people are interested in, like that's what we want to do. That's what I wanted to do. And another thing here that we hear sometimes is, well, if you proceed with a policy like this, it could MEC, meaning it could be a taxable event. You don't need to worry about this at all. It's very easy to prevent a modified endowment contract, a taxable event from occurring. We can even reverse it as long as we catch it within 30 days, which we always catch it the next day because the insurance company receives a notice. They notify you, notify us, and to reverse it, we just need an email from you, the policyholder, saying, I don't want to MEC, please reverse, and they refund you the amount that you've funded the policy in excess of the MEC limit. Now, what I'll say here is if a policy does become classified as a MEC, the cash value is taxed when it's accessed, so we want to prevent it, obviously, but again, it's easy to prevent. Real quick, every policy has what's called a MEC limit. Think of it as a taxable line. It's the maximum dollar amount you could add to the policy every year. The fun part is we can set that wherever we want. We've got some videos. If you have questions on that, let us know, or we can send some videos that describe the MEC and how to set the MEC limit. But if someone says, I want to be able to fund $10,000 per year, what we'll do is make sure we set the policy up with a minimum of a $10,000 MEC limit. Maybe it's even a little bit higher. This way we know we never have to worry about the MEC occurring as time passes. You'll see that the MEC limit has a direct relationship to the death benefit in a policy. There's an IRS rule around it. But again, very easy to prevent. Main thing, where's your money going? Minimum base premium, is it close to 10%? If it's not, what are the rules with that company and product to make sure it's at the minimum the company will allow, and then have the ability to max out that PUA rider. That's going to juice the cash value. So remember the I don't want this and I want this example for the doctor. So let's look at those two examples. These are the exact same policies, but what do you notice here? There's another column in red, agent commission. And this is displaying the total annual commission paid to the agent. And this is based on our company's rates with these specific products, which when I say our company's rates, as you produce a lot of business with insurance companies, they typically continue to increase your commission rate. So these are among the highest. There's companies that pay a lot more than this, but we've got the highest rates with these two products. We're not showing a high rate with this product and a low one with this, like none of those games. With the I don't want this option, you have zero cash value in the first year. How much would I make? Yeah, $93,000. Compared to the option on the far right, you pay $100,000 in, you've got almost $89,000. How much do I make? $7,600. Significant difference. I make more in the first year with the example to the left than I do over the full 10 years with the example to the right. And why those commissions stop after 10 years is because it's common for insurance companies to stop renewal commissions after 10 years. Some will continue them with a small 1% to 2% renewal fee, but for the most part, they are paid over a 10-year period. So from a compensation standpoint, it is good to have this knowledge, just knowing that if a policy is set up for maximum cash value, the commission will be minimized. However, I said it is a win-win, because if this is you, is this a bad deal by any means? I don't think so. Depending on the company and product, that could be a little bit higher or lower. And you've got a residual component here. You've got a happy policyholder with this, so you don't have issues that pop up over time. You receive more business through referrals and such. The model does work. You just have to be really disciplined in the beginning because as an agent, you do make less. But again, as time passes, it gets easier and easier, speaking from experience. So that is information on how to maximize the cash value. Key is minimize the premium, maximize the PUA rider. That'll give you flexibility because you're only committed to the premium, and then maximum cash value. So more money working for you and more money you have access to for opportunities. Speaking of opportunities, let's talk about how you can use the cash value. So business owners and real estate investors. These are two common examples we see a lot. I'm going to use them to illustrate how people use the policy, but you could really use it for anything, and the same principles and models that you'll see will apply to any type of use. So, looking at a real estate investor will typically use the cash value to enhance what they are already doing. The life insurance policy and the cash value is not going to make them wealthy. What their real estate will make them wealthy. Cut. 1, 2, 3. Make them wealthy. It's typically their real estate portfolio that makes them wealthy. Looking at the life insurance product, they see it and say, okay, this can benefit me and make what I'm doing right now a little bit easier, a little bit better. It makes sense. That's why I want to do it. Also, it's common to see someone who is very, very heavily involved in real estate relate to cash value life insurance. They pick it up quickly. And the reason why is because the cash value and accessing it functions very, very similar to borrowing against real estate. So to illustrate, imagine that you own a property and its value increases by 5% every single year. So we're in a perfect world where the fair market value of your property every single year goes up by 5%. And today, it's worth $1 million. You see another opportunity. You want to buy it. You access equity in your $1 million property today. You take a $500,000 loan against it. How much do you have remaining in equity? $500,000. The $500,000 loan you took, what happens with that? You pay interest to a bank or the lender. So the interest rate is how the bank makes money. Question. The 5% appreciation, do you receive that on your entire home value, the full $1 million, or only the $500,000 remaining in equity? Meaning if you sell that $1 million property, how much does it sell for? Just the remaining equity? No, the full $1 million. So if it's appreciating at 5%, you continue to get that on the full property value. So that's an attractive feature to real estate. A lot of people like that. I like that. Like, that's why people often invest in it, or one reason why. So relating that to cash value works the same way. A difference here that a lot of people find attractive is that I've got more control over the cash value, that is. So when I have an opportunity, meaning a piece of property that I could purchase, I can do the following. I can pay with cash if I've got cash on hand. I can finance it through a bank, pay interest to the bank and deal with the bank's terms, or I can finance it with my policy. The questions that come up here are often, well, what are the policy terms? Do I have to pay it back and such? Which here we've got the question, do I have to pay a loan back? The answer is no, you don't. But it does make sense when you look at the numbers, when you're actively using the policy. But again, you do not have to in most cases. One of the best things to do, and this is something our company does for everyone we work with, is show people what a policy looks like if we borrow and repay, or if we take a loan and don't pay it, or maybe we only pay interest, or maybe we don't make payments until year 10 or 10 years from now. This way we can see different options and understand what the pros and cons are to us and our money. That's very, very important because we don't want to make a decision without having information on exactly how it will work. And regarding loan payments, what I will say here is when we are in retirement and we're no longer actively using the policy for real estate, we're just taking income. In that case, we typically do not see individuals repaying loans. So let's look at an example of a policy. We're going to look at a loan here, and this will be fun. So what we have is as follows. We've got a 45-year-old male, and he's funding a policy for a short period of time. How long is he paying into the policy? 5 years, $100K per year. The example to the left, we've got growth, meaning he pays money in, lets it sit and grow, never touches it. Compared to the option on the right, what's going on here? He's borrowing $300,000, and then he's repaying it over time. So in this example, what do you notice? Look at years 1 through 5. By year 5, your cash value is $507. The death benefit is $1.8 million. Example to the right, same thing. We take a $300,000 loan. What happens to your cash value? Drops. What happens to your death benefit? Drops when we compare it to the examples on the left. How much did the death benefit drop by? The exact amount you borrowed. You'll see that happen every single time. Whenever we borrow against a life insurance policy, your cash value is your equity. That's the gauge that determines how much you can borrow. You can typically borrow 90 to 95% of whatever you have in cash value. The death benefit is held as collateral anytime we borrow. So if we take a loan and we die when a loan's outstanding, the death benefit will be paid out minus the outstanding loan. Now in this example, he pays it back. What do you notice here? Once the loan is repaid, the values are fully restored to exactly what they would have been as if we never touched it in the first place. Constant compounding. So a couple bullet points here. Number one, if I've got cash value at $100,000, assuming it's earning 5%, I take a policy loan for $50,000. Let's assume the cost to borrow is 5%. Where does that 5% go? To the insurance company. Just like a $50,000 line of credit, the interest would go where? To the bank in that example. So I borrowed that $50,000. How much do I have remaining in equity when I look at that? $50,000. Let's get myself out of the way. So you had 100. You borrowed 50. You've got 50K remaining in equity. Here's the main thing. The 5% net growth rate that we started with on the full 100K is still applied to the full 100,000. You're paying 5% on the 50K you've borrowed, but you're still receiving compounding on the entire amount. Now, quick side note, if you've really dug into technical details, some companies do things a little bit different. You've got terms such as non-direct and direct recognition, but generally speaking, you'll see formulas that work very, very similar or exactly like this. So how this works, number one, the insurance company does charge interest for the loan. So how does this work for the insurance company is typically the question. They are making money on the loan, which helps offset the cost. And then also they collateralize the death benefit. We do want to remember that. So their first and foremost obligation is to pay life insurance claims if anything happens to us, if we die, but collateralizing the death benefit does grant them some protection there. Who do we work with? So we're going to get into who our company specifically works with. We work with individuals, small businesses, and banks. We do have experience and we are able to work with and service banks. You do have to go through some training or have some experience there, so we are able to do that. Individuals we work with. We do require that individuals we work with have at least a basic understanding of whole life insurance. You want a whole life insurance policy because you understand the basics and you see that it can benefit you. You're learning about it. You say, okay, this can benefit my situation. I'm interested in it. You have an idea of what you want specifically. You know how much you'd like to fund the policy with. And that doesn't have to be an exact amount. Could be a lump sum. Could be a fixed amount for a number of years or until a certain age. Or it could be a flexible plan. For example, one might say, I'd like a policy where I could fund up to $100,000 per year. But I'm really, really nervous about getting a bill for $100K every year. I don't think I could handle that, but I know I'll be able to do it, or I think I can. What we would do in a case like that is set it up where it's flexible, where they're committing just to $10,000 per year, and then they can add additional funds at their discretion. So we have an idea of how we want to use the policy. You don't have to know exactly what you want. You might, and that's great because then we can really streamline the process. But if you're still trying to understand what the numbers look like, or you want to see options first, that is 100% okay. And that's one of the things we really like to spend time with people on to make sure we get everything set up correctly for them. What questions are you not asking that you should be asking? And then we'll provide that information. This way we can ask them for you or say, hey, by the way, here's a question a lot of people ask that are in a situation similar to you. This way you've got that additional insight and can really fine tune everything. So you have an idea of what you want. Then how do you plan on using the policy? A couple examples here. Is it a safe place for your money? Are you attracted to the safety? Maybe it's the tax benefits. Maybe it's your business, real estate. Perhaps it's legacy planning. Could be a number of things. But if you have an idea of what you want with respect to how much you'd like to fund the policy with, that could be a range, and how you plan on using it, that's who we work with, an individual who has started to do research, they understand the basics, and they're ready to have a conversation, or they've researched everything and they say, I know exactly what I want, here's how I want it set up, let's look at next steps. We'll say, okay, everything looks good, or everything looks good, but have you considered this just in case? This way we make sure we're not overlooking something very important. So can you answer these questions? How much would you like to fund a policy with annually? So how much every year would you like to fund a policy with? How long would you like to fund a policy for? And then how would you like to use your policy? Some helpful tips here. You should have a general idea of how to answer these questions. You don't have to know exactly what you want, which is nice. I'll also add that the numbers often change after we review illustrations and have a discussion. They typically don't change a lot, but things are tweaked. So a quick example, how much would you like to fund a policy with? Someone might say, I've got a lump sum of $200,000. I'd like to start with that. But then afterwards, I'd like to commit to a minimum amount of $5,000 and be able to fund up to $50K. So they provided the information. I want to start with a $200K lump sum, commit to $5,000 so it doesn't feel like a burden, but still have room to add more money into the policy. How long would you like to fund? That same person might say, I only want to fund it for 5 years because I'm 55 years old now. I want to stop at 60. Or that same person might say, I want to be able to pump money into the policy forever, or show me the options. But again, we're getting an idea, or you're able to provide an answer and provide us with an idea of how much and how long you'd like to fund the policy for. Those are the two main things. This is additional information here. How you would like to use the policy. A lot of times people will just say, to maximize my cash value and use it for opportunities as they come. Show me a loan model, or I already know how loans work, but that does help us as well. So let's look at some examples of what people said when they were ready to work with us. So the following slides, these are examples of actual clients, people we are working with or are currently in the process of starting a policy. They're in the initial stages. But what I'm going to go through is what they sent us, whether they came across our website and provided information to us, or if they emailed everything to us. They told us what they were looking for, and I'll go through exactly how they presented the information. And it made the process very, very streamlined, and all of our conversations were extremely productive. So we'll start with an attorney. He let us know that he lives out in Nevada, out in the desert, and he wants a policy set up for maximum cash value with an annual funding range of $250,000 to $300,000. He needs flexibility in order to make catch-up payments over a 7 to 10 year period, and funding beyond that is not really a priority. So when I see this, it's apparent he's done a lot of research because he put in there catch-up payments. That means if he has a year where he only pays $100K, and the next year he sells a piece of property and wants to pay $600K in, can he do that? The answer is yes, he can. And he's got the funding period, 7 to 10 years, not really that interested in funding it for a longer period of time. And then how he plans on using the policy is to borrow heavily against it for real estate syndications over the years. And then eventually he plans on paying off all the loans. I'll add something here. It's very, very common to see people aggressively fund policies for a short period of time, use the policies through loans and such, and then after that, after call it 7 years in this individual's case, they won't fund anything else, and they'll dedicate resources to repaying the loan. It's common to see people do that. An example of a business owner. So this guy had actually emailed us. I remember the day he emailed in. He said, I own a company with 49 employees and strong cash flow. My CFO recommended whole life insurance policies as a way to diversify investments and banking. I've studied the idea and watched videos for about a week. I'm interested in funding a policy with $300,000 to $500,000 per year and potentially a $1 million lump sum upfront. He also provided his age and such, but a case like this allows us, before even meeting with the individual, to prepare this for him, send it to him, along with information that will answer a lot of commonly asked questions that is tailored to his exact situation. This way, when we meet over that call, he's had a chance to review the material. His CFO is also on the call, and they have all the information up front, and it makes that call so much more productive, because if he owns a business with 49 employees, he doesn't have time, or he's limited on his time. So I want to make sure that I'm considerate of that when we're working with him. An example of an engineer, I remember this email coming in. So he's 42 years old. He owns a transportation company, 7-figure revenue, does well. His wife is a doctor at a major hospital, and he wants to fund the policy, similar amount to the last guy, $300,000 to $500,000 per year. But look at that piece he added right here, without being on the hook. So what he ultimately moved forward with was a policy where he could fund up to $500,000 per year, but he's only billed for about $50,000 per year. This way, he's not on the hook for a $500,000 bill every single year. Flexibility is important, and this is what we received from him before having any conversations. And then lastly, he wants access to cash value for opportunities. Next, we've got an investor. He had a lump sum of cash, a little bit under the age of 40, healthy, married with 1 kid, makes $120,000 per year, but he's got a lump sum of $1 million, and he wants to use this to move it into a policy, maximizing cash value. The mindset was, I've got it in cash now. I'd like to put it somewhere other than cash because I'm not comfortable with leaving this much money in the bank, but I still want it to be liquid. I want to be able to access it. I've done a lot of research around whole life. This is what I want to do. So what he did was exactly this. He moved the money into a policy. I believe this was a case where it was done over 4 or 5 years. I believe it was 4 payments of $250,000 per year, just aggressively getting the money in. And then he also added that eventually he'd like to take out a policy on his son and his wife. Now we've got a working man, 52 years old. He let us know, I'd like to fund a policy with up to $90,000 in the first year, but I only want a minimum commitment of $6,000 per year and then be able to fund $60K per year. So he wants to start with a large lump sum, be on the hook for a small amount, and then still have room to add more money, $60K per year. And I'd like to pay into the policy for 2 to 10 years. So this is a really, really good case. I like this a lot because he's 52 now, large lump sum up front. What I'd want to know if I'm him is what's it look like if I do $90K in the first year, 6K in the second year, and then I stop. Kind of a worst case scenario because he knows he can do 90 right out of the gates. Will the policy still perform at a high level? The answer is yes, it will, with what you can do from a design standpoint. But that's what I would look at in terms of a worst case scenario. Then I would look at that exact same policy, or here's what we would show him. We would show him that exact same policy, but what it looks like if he paid 30K per year. Maybe it's through year 10, then 60K if he max funds it. But showing the same policy and different funding scenarios. So he can see, what does it look like if I only fund the minimum, if I fund it at 50% of the maximum, or if things go really, really well and I max fund it. And then in reality, things are going to change over the years, so we always track the performance of the policy. Another working man, 46 years old, earns about $100,000 per year, or a little bit less actually, and he'd like to look at a policy where he's committed only to $5,000, but he can go up to 50K per year. So funding $50,000 per year when your income is just about at 100K, that's high. That can be excessive. Yes, you have access to the cash value, but that doesn't always make sense. So this is common to see a request like this and someone proceed with a policy like this when they know that their income is going to increase over time, or they've got other things going on, or maybe their spouse is about to start earning a lot more income. They'll say, you know what? I want to start at a policy where I've got a minimum that I never stress out. Based on my situation right now, I can handle 5K, and I think I could even get 50K in a year or two right now. But during our conversation, we learned that they've got other things going on in terms of assets or money coming in, and they'll be able to add more. So this is why we receive this information and why we often see requests like this. And then another thing he asked here, how much death benefit would this purchase and when would I break even? So that right there tells us he's done a lot of research here, which is nice. I remember the email from this family. The mom started out with the communication, and she's actually got a real estate business with her and her 2 boys. She's interested in a high cash value policy. She used the verbiage 1090 split. What that means is a 10% premium, 90% PUA ratio, which means we know that she's done research based on that alone. And what she wanted to do was start a policy where she dumped in $150,000 and then funds between $25,000 and $50,000 per year after that. After the 5th year, so 25 to 50K through policy year 5, after the 5th year, she'd like to pay either a minimum of $5,000 or stop altogether. And then she'd like to use the policy, or she'd like to have immediate access to the cash value for her real estate business. Now, I don't believe that she took an immediate loan because she didn't need it, but she wanted peace of mind that it was there. So that specific policy was set up where the minimum was just about $5,000. I think it came out to like $6,500. We got it as low as we could. She started with a large lump sum. We used Guardian in that case because Guardian allows large excess lump sums. Then she's committed to $6,500 a year and can pay between $25,000 and $50K annually, no problem. And the policy was on one of her business partners, which is also one of her sons. But I do recall that. A bad example of providing data, and this is not a horrible example, but it did not give us all of the information we needed. So this individual, really nice guy, provided his date of birth, non-smoker, in good health, ready to have my medical interview. So that indicates he's ready to go. That's very helpful. He wants a high cash value policy. We see that he's already speaking with an agent. He wants a 1090 split. So again, apparent that he's doing research here. So this is all good. I spoke with another agent and said he doesn't design policies under $20,000 premiums. Okay, that is good information to be aware of. That means he's talking to other individuals and trying to get things right. But then we've got, can you show me some samples similar to what you show in your webinars? So my answer is yes, but what would we need in a case like this? We would need how much he'd like to fund and how long he'd like to fund. It can be a ballpark too. If he's able to provide that information up front, Then we can provide that information, illustrations to him. We can go over it more thoroughly during our call. Now, of course, he may have just forgotten, and that would be a case where we could call him and get the information over the phone. But if we're able to get it up front, that helps so much, and it lets us know really that you're ready to begin the process as well. Here's a good example of providing data for someone nearing retirement. So I'm 58 years old, planning on retiring in about 7 years and seeking some guidance with respect to financial education. Can you provide a proposal of funding a policy at $100,000 per year for 5 years with growth potential and flexibility? Yes, we can absolutely do that. That right there is perfect for me because we've got your age and how much you'd like to pay. We don't need information on the health unless you've got a serious health issue. That helps to let us know up front, but we'll run it as standard or regular preferred, one of the middle classes to kick things off and let you know that that'll change a little bit if we get a different health rating, but we're just providing something so you can get an idea of what the numbers look like up front. And why he was interested is because it'll help him better fund his retirement. So very, very helpful in terms of him providing information. Talked about this one a little bit before, the two business owners. So they are funding $2 million per year. That was their plan. So the first email, as far as what they provided in terms of information, is as follows. We're interested in the cash value as an asset on our company's books. We want to use the policy for our business and real estate construction. They've already begun using the policy for their real estate construction. We've seen them frequently add money, borrow it out as needed, and we see them putting it to good use, which is always really, really cool to see. What they were interested in, is one larger policy, $1 million per year. So a $1 million policy means they want to fund $1 million per year. That'll be owned by their holding company. And then smaller policies where they can fund up to $500,000 per year for some of their companies or locations on the West Coast. They've got a lot going on. And they want to use the policies to invest in their growth and also their business. Here we've got potential retirement benefits for core employees. And then they want to ensure financial cash flow for retirement and long-term care legacy needs. Here's a very, very important piece to them. Flexibility, high cash value, and being liquid. The flexibility is huge for them. And I'll say this, they've got the cash flow to fund their policies with $2 million per year. However, as a business owner, does cash flow always come in exactly when you anticipate it to? No, things are going to happen. Even when everything should come in on time, delays pop up. Things are outside of our control. So their policies are set up where they're committed to about 10% of the total amount they could pay. And this is very, very easy for them to handle. So they're committed to a minimal amount and then can just pour in excess funds at their discretion. Never feels like a burden. So I can commit in this case to approximately $200,000 per year. Comes out to a little bit more than that just with the final design and such, but committing very, very close to the minimum and pouring in excess funds 100% at discretion. And then lastly, for this case, estate planning and tax attorneys were involved. Funny story, we actually referred them to that same tax attorney and estate planner that I had met through that wealthy couple I spoke about earlier, just because I started working with that tax planning firm and it was a perfect fit. So the meeting worked out really, really well as I look at it in the big picture of things. Let's go through a couple case studies here and then we will wrap up. So case studies, business owner. So we've got a business owner here that over the years and working with us, he's got 8 policies, and his largest policy he funds with more than $250,000 per year. He found us through our website after watching some of our content, and he was initially interested in policies owned by his business. He clearly stated his goals up front, reviewed a few options. We did show different companies and products. However, he decided to put everything with Guardian because of their flexibility, specifically their PUA flexibility. So Guardian's a major mutual company, and they will allow you to commit to a small amount. For example, his $250,000 policy, he can commit to about $250,000 per year. He can commit to about $25,000 per year and then just add additional funds at his discretion. So he's not on the hook for a high dollar amount. Another business owner here, he had very clear goals and decided that Mass Mutual was best for him. After watching content and reviewing different companies and products, he had an idea of what he wanted. We agreed with him. We asked, would you still like to see an alternative option that other people have looked at in your situation? Yes, I would like to see that just to make sure I'm not missing anything. Looked at it. Hey, I'd still like to go with Mass Mutual. After the second call, he started the process, and then later he started policies with his children, or for his two children as well, and he funds his policies up to a total of $70,000 per year. A rancher, I remember him. First time I met him, he had a cowboy hat, and he was a cool guy. That was a lot of fun meet with him, and I like him and his family. They've got a really, really, really good mindset, and they work really hard too. So he wanted to deposit up to $300,000 per year, and that's what he did. And he still has that policy. Before meeting with us, he had spoke with other agents, very, very focused on maximizing the cash value, very intentional of having a low premium and the ability to add more money at discretion. So he ultimately decided on Guardian. Here is the design he has. But he spoke with a lot of individuals, and the only reason we got to connect with him is because he wasn't shown what he wanted before. He had been doing research, been speaking with agents and saying, this is what I want. Can you provide it or show me this? And he was being told, no, here's designs with higher premiums, which means it's a higher commission, and he wasn't going to do it. He knew what he was looking for, and fortunately, we did get to connect with him. We're very thankful that he decided to reach out, and we've been able to work with him for a couple of years now, which has been great. We've got a family of 4. They've got 4 policies in total, 1 on each family member. Found us, again, through our content. He was initially interested in funding a small policy, just funding it with $5,000 per year. And after really learning how it works, how he could maximize the cash value, how he could use it for other things, he said, you know what? Let's take out policies where we can fund up to $150,000 per year. So we did take our time with that. I'm very, very big on making sure we understand what we're getting into, especially when we go from $5,000 to $150,000. That's a big, big increase. It was after he understood, hey, it's not just a life insurance policy where I'm saving long term. I like that, but I want to be able to use this thing, meaning I want to pump money into it. When an opportunity comes, I want to be able to borrow against the policy, and that's exactly what he's done over time. Then we've got an airline pilot. So he was working with another agent before he connected with us. He reviewed illustrations with that other company, wasn't happy, mainly because of the cash value. It was not high. He said, this is my money going in. I don't want to take a big hit in my money out of the gates. I'm not into that. Reviewed options with Mass Mutual and Guardian, decided to open policies for his family. He funds 6 figures annually. He's got the ability to. A lot of times what we'll see with airline pilots is they've got an excess amount of cash that they'll fund the policies with, so they don't have to rely on their income to fund the policies they've saved already. So typically we see them moving excess cash into a policy. Then they've got the option to stop, or he can kick this 100 down to 10K, or maybe it's 20K per year, something like that. But it's very, very flexible there. So he can start aggressive and then take his foot off the gas. Someone who switched agents. So they were working with another agent. They recognized their policy, again, was not set up for maximum cash value. They wanted a policy that didn't feel like a burden. What I mean when I say that, they didn't want to be on the hook for a large amount of money every year or every month. So they took out a personal policy with Guardian. As time passed, they also opened a policy with Mass Mutual. Here's a doctor. This is not the doctor that we shared the story earlier about. This is another individual, really, really nice guy. have worked with him for several years now. He's based out of Florida, and he's got several policies. Before we met him, he had started whole life insurance policies with another company, and they weren't maximized for cash value. His financial situation from when we first connected until now has improved quite a bit. It's improved over the years. So more recently, in addition to the policies he already has, he started a very large policy where he wants to be able to aggressively fund it for 20 years. He's early 40s. He has a specific goal of wanting to fund it until retirement, a little bit beyond age 60. He's like, this is what I want to do. So what he did with his most recent policy, he went with Guardian, again for flexibility. He's committed to just about $40,000 per year. That's what he pays yearly, but then he can add additional funds to the policy up to a total of $360,000. So I'm committed to 40. That amount does not hurt him at all based on his income, but he can really scale the payments as time passes, which is nice. He also uses the policy frequently. He's borrowing, repaying very, very frequently, and then during retirement, he does plan to take income from the policy on a tax-free basis. That was appealing to him. Another doctor, I remember her, she lives down in South Carolina, and her husband took out policies where they're funding $200,000 per year. They preferred Guardian mainly for flexibility. They were very, very proactive in providing the information during the underwriting process in order to get a quick approval. They wanted to start fast, and she knew what she wanted when we first connected. She's like, I know what I want. I just want you to provide the best options that fit my situation. When I say she knew what she wanted, she said, here's how much I'd like to fund the policy with. Here's the research I've done. Tell me if I'm doing this right. Tell me a little bit of information about what other people do, but really tell me what you would do if you were in my situation with the numbers I gave you. So she had her finances locked down. She budgets and everything and knows what she can do. So with that information, we prepared everything and said, here's what we would do. And she liked Guardian because of the maximum flexibility. So here we've got a realtor. They were very easy to communicate, knew what he wanted to fund $100,000 per year, did not need much guidance because they had dug into the information. Again, did his research, knew what he was looking for, was approved fast in about 2 weeks from applying. And then after the approval, but before starting the policy, he decided to increase the annual funding to $150,000 per year. Then he's also got 3 kids that he plans on starting policies for. We've got a construction supervisor here, a lot of different individuals that are in different professions. He has policies with both MassMutual and Guardian, mainly because he wanted to diversify. His first policy was with Guardian because of the flexibility, commit to $5,000, go up to $50,000. After he got comfortable with it, started a second policy with MassMutual where he funds up to $40,000 per year. Insurance executive. So this was someone I worked personally with and spent a lot of time with. When he started his policy, he was in his mid-50s. He earns a lot of money, between $500,000 and $700,000 per year. It fluctuates depending on his annual bonus. Now, he's extremely conservative. He had several $1 million in cash, checking, savings, and money market accounts because he doesn't like risk. He has some risk through qualified accounts and such, but he doesn't like it. That's why he's got so much money in cash. So what we ultimately did as we looked at different illustrations and planned everything out is he moves $400,000 per year into his whole life insurance policy. His current plan is to stop after 4 to 5 years. So it's after he gets $1.6 to $2 million into the policy. He wants to stop, maybe continue to pay a small amount, but that's what he wants to do. We had a very specific plan after we looked at everything. Again, the interest here was the cash value. The safety and tax benefits were most appealing to him. He may access it, but loans were not. They were not the priority by any means. The death benefit was important because that can be leveraged in his retirement plan. This was actually a case where we built out a retirement plan and looked at his situation without life insurance and then with life insurance and how he could spend money aggressively but also leave a legacy. and the life insurance policy gave him, call it a permission slip, to spend other money more aggressively. And then he wanted a major mutual company. The guaranteed values were very important to him, and he knew what questions to ask. I'll add something about him here. So we've got an insurance executive here. He works for the second largest life insurance company in the world. And the company he works for is a stock company. That's why he reached out. He wanted a mutual life insurance company for his own personal policy. But he had actually made a comment because he had spoke with another group before we connected with him. The other group recommended a smaller life insurance company. And his response was, there's no way I'm going to flow this amount of money through a smaller life insurance company. I want to go with one of the major mutuals. That's who he was comfortable with. So that speaks to someone with firsthand experience in the life insurance industry, seeing how things have worked over time, wanting a quality company because he wanted to make sure it actually delivered here. That stuck with me, particularly when he said, there's no way I'm flowing my money through a smaller company. Like, I'm not doing that. So, a lot of information there. And I'll say this before I get into this piece. A lot of those were big dollar amounts. And a question we get sometimes is, do we only work with people that are paying in $50K per year or $100K per year or more? And the answer to that question is no. If you're in a situation where you're funding a smaller dollar amount, 10 or 20,000, maybe it's even less than that, we do still work with you. We don't want to turn people away because they're not in a situation to write a check for $100,000 every year. Like, no, like my first policy was less than $200 per month and I still have it. I'm very, very big on starting with people who are trying to get things going. The thing we do ask is, regardless of the dollar amount someone's funding a policy with, is that they can answer the questions we asked earlier as far as how much I want to fund, how long I want to fund. They understand the basics of whole life insurance. By the time we work with them, they've got an idea of what they're looking for or know exactly what they want. That really makes your time more productive, our time more productive. We're having very, very productive conversations. That's really what we're looking for when we work with individuals. We have one-on-one meetings, but when someone has invested time to understand the basics and such, that's really who we work with. So how do we work together? We're nearing the end here. On your side, you want a whole life insurance policy and you want the cash value maximized. That's what you're interested in. You understand the core benefits of whole life insurance, particularly around the cash value. You can provide numbers around how much and how long you'd like to fund a policy. Again, a general idea that does not need to be exact. You feel that we're a good fit for you and you want to work with us. If it's a yes, let us know that you'd like to move to the next step. And also let us know if you have any questions in advance. This way we can prepare them and deliver answers. My big thing is when we're working with someone, if you've got questions and you email them to us or text them to us or even ask us over the phone, we want to provide them in writing if at all possible. This way you've got a written response and you can always reference that if the same question pops up. 2, provide a personalized recording whenever possible. So when we send you illustrations or proposals, instead of just saying, here you go with a written description, we like to include a short recording, which is a lot like a Zoom call, but we're adding talking points over the material. This way you have a resource you can reference as far as exactly what you're looking at. You can understand it now. This way, again, when we connect, a lot of questions are answered through that recording. It makes our time more productive. And then also, you've got that resource you can go back to. So a written response and a recording gives you something you can go back to as many times as needed, because this stuff is very easy to remember, isn't it? No, it's not. That's why we do that. So from us, when working together, what we'll do is meet to discuss your policy. And we can meet with you over a Zoom call. That's typically how we do it. We can connect over the phone. Some people prefer to connect via email first. That's perfectly fine. But we will absolutely meet with you to discuss your policy. We'll design your policy We do like to review different companies and products. First, really listen to you and see what company and product you're interested in, or if it's multiple ones, what are you interested in seeing, and make sure we show you that. And then if there's an option that we see is better for you based on your situation, we'll show you that option and let you know why we think it's better based on the information you provided. What's best for you, that's really what we want to look at there. And then reviewing the illustrations we send. So we talked about meeting to discuss that. Also recordings. We found a lot of people like that. It's very, very helpful. Help you use your policy over time. Share what others do in similar situations to yourself. And then provide you with access to our team. So what does that include? Because our team is fairly large. So you will have a primary associate. This is a licensed life insurance agent that can discuss life insurance with you. Your policy can run illustrations, but then also multiple departments. You'll meet our case management team. You'll meet our client relations team. Our case management team assists with your application and underwriting during the approval process. The client relations department, their team is fantastic. They help with everything post starting a policy or post policy. So once you've started it, you've got questions about your policy with respect to loans, accessing your online account, you're trying to get information, you're trying to change beneficiaries. We've got a team here that is in place to really assist you with your needs in addition to your primary associate, which you can reach out to anytime. If we don't hear from you, you will hear from us. So we do make it a point to reach out every 6 months just with updates on your policy, a review of the current cash value and loan balances, and an offer for a review meeting. This way, we can always keep our finger on the pulse of your company, product, and the overall situation. The purpose of those meetings, if you do elect to take them, they're always optional, is to provide updates, again, on your policy. The purpose is not to sell new products or anything like that. It's a very, very big thing of mine. We're not doing that. If you've got questions or you're interested in a new policy, yes, we'll definitely help with that. But we're not going to be bringing up new products to try and sell or anything like that, because I don't like it when people do that to me. Our resources. So when you partner with us, because we do view this as a partnership, because you've got a policy for life as long as you keep it, and we're here to help you for life. You do gain access to our team in addition to additional resources, and this is all in addition to your whole life insurance policy. So some of our resources, we've got a client user package. These are videos that are not on YouTube. They're short videos that range between 1 and 5 minutes. Some longer ones are up to 10 minutes, but they provide very, very specific answers to questions on different companies, products, when dividends are paid, how loan interest works, common questions that come up for individuals that have policies. The client user package provides that information through video. So they're short videos. Access to contacts. So as we continue to grow and establish more relationships, we do provide access to contacts and resources we have. Law firms, for example. There are 2 resources we use right now on the tax and estate planning side of things. The other groups here, there is a CPA that we do like a lot, that we've referred business to. He's got experience with whole life insurance and business owners, financial advisors, real estate investing groups. As we find reputable ones, we absolutely will make introductions and such. We get a lot of questions about this. And here's my thing. When it comes to real estate groups, before I make an introduction, I want to make sure, one, that the person we're introducing you to really knows what they're talking about. Like they're a master at their craft. But then 2, they do the right thing. Like they're not going to try and use the knowledge they have to put you in a product or service that's not in your best interest, similar to how we approach whole life insurance. We want to make sure that we know our stuff, and then when we put someone in a policy, that it's set up for their benefit and maximizing the cash value, not ours. So we've got to make sure, or I need to make sure, that anyone we are referring in a different field approaches their business in the exact same way. I know EMA Legal, which is the law firm I mentioned earlier with that with the wealthy individuals. That's how they operate. They know their stuff, and they're always looking out for the best interest of their client, not themselves, which is extremely important. Some other resources: Excel workbooks, some of our loan workbooks. We've got a loan workbook that a lot of people like to use, which allows you to take any of your illustrations, drop it into Excel, and you can run different loan models to see, hey, what would it look like if I take out a $50,000 loan here and I pay interest only or pay it back later? How much do I pay in loan interest compared to how much does the policy grow? And does it make sense? And then we also track policy performance, which is seeing what the actual results look like over time. And what we do is take the annual statements the insurance company gives you, put them on Excel. This way you can just look at how much you paid in every year and cross-reference that with what the cash value actually grew by every year. Who will I have access to? We hit on this a little bit before, but I just want to make sure I really lean into this. One will be a primary associate. This is your primary point of contact. So you can always call, text, email anytime. 2, our case management department. They'll help you once you say, okay, I'm ready to start with this company. I think I like this product. What are the next steps? They'll assist in collecting all of the needed information and also getting your case through underwriting for a favorable outcome. But you'll get a lot of communication from them. And then also our client relations department, which once the policy is active, they're there to help. And they help with policy adjustments, changes, policy loans, transactional items that require attention. And all of our departments are very good at what they do. When it comes to client relations, that department we started several years ago, and a big reason why has to do with customer service centers at insurance companies are good at what they do, but typically the customer service reps are not licensed, and they were not involved in the planning of an individual's policy. They don't know all of the ins and outs because they're not trained on it. And it can cause frustration where information is given that might not apply to your actual policy. So we put a department in place really to be, call it the middleman between you and the insurance company. You can always reach out to the insurance company, but now we're here to make sure any information you receive is accurate. Or if you request a loan and an error is made on your online portal where you say, I want it sent direct deposit, the company mails out a check, you're on vacation so you can't get that check that week or that month, you're like, I need the money, what's going to go on? That's where we're here to call the insurance company, make sure a stop payment is placed on the check, make sure it's sent via direct deposit. We communicate anything needed with you if we need signatures or anything like that, and we make sure that it's handled promptly. This way we can shorten a delay that might usually take 10 to 20 days. We can trim it down to 2 to 3 days. So that's the kind of stuff, or an example of the kind of stuff we want to make sure, or we make sure we're always on top of. So deciding if you would like to work with us. It does need to be a fit on both sides. We want to make sure that we're a good fit for you and vice versa. Having a healthy relationship is extremely important, especially when it comes to your money. So number one, when deciding, you'd like a whole life insurance policy set up for maximum cash value. That's why you're interested. That's why you reached out. That's your goal. You'd like to understand what you can and cannot do with your policy. This could be specific to the insurance company and product you select. You want to know how you can use it, and you want us to help. You'd like to be able to use your policy on your own, but you'd also like to use us as a resource when you need help. For example, you want to know how you can take policy loans through your online account so you can move fast. But you want to know what the numbers look like before you take that loan. Specifically, what's the impact on your cash value? What happens if you don't pay the loan interest? Your online account won't show you that. So that would be an example where you could reach out to us. We could prepare that for you, and that can be before or after you take the loan. If you take the loan and then you find out, hey, this might not have been a good idea, no worries. We can always pay the loan back quickly, and then we only pay interest for the days that it has accrued. So not a big worry there by any means. Here's a question that comes up. Should I request a loan through my online account or use your company or our office? I always like to recommend our office. Issues occur with insurance companies probably every 1 out of 100 loan requests, but usually when it occurs, it's at the worst time. So if we're involved, we can just make sure things go through smoothly, and if an issue does pop up, we can catch it immediately, which is important. Another thing when deciding if you'd like to work with us, you would like us to answer questions and assist with your policy instead of a customer service center at an insurance company. And then lastly, you understand the core benefits of whole life insurance and feel that you will work well with our company. Next steps, if you are ready to start a policy, let us know the following. And you can do this via email or just by contacting your primary associate, which would have been the person you received an email from. How much would you like to fund a policy with annually? How long would you like to fund your policy for? And then provide a brief summary of how you would like to use a policy. And again, these do not need to be exact numbers. We know not everyone knows exactly what to do, but just a general idea of what you're looking for with a policy with respect to the dollar amount, funding period, and what you're planning on using the policy for. That helps so much. And if it's an in-depth conversation, I promise we'll get into the details. Details are always uncovered. And if you've done this already, no worries. We already have the information. If you haven't done it, you can easily do it on our website, ibcglobalinc.com. You'll just want to click, I'm ready to start a policy. And if you have questions, that's how you can let us know. Feel free to email us or contact your primary associate. Thanks again so much for watching this all the way through. I'll end with this. If whole life insurance is not a fit or our company is not a fit for you, that is okay. I do hope that you're able to learn more about the product and learn something that you feel you can help others with. So if you ever run into a friend or family member who's considering whole life insurance and you see that the cash value is not attractive up front, you've got 0 in the first year, now you know that you can say to them, hey, that doesn't look right. From my understanding of whole life insurance, you could have between 80 and 90% of what you paid into the policy in the first year. So I do hope that the information was helpful. Thank you again so much for your consideration. I do appreciate it. And if you are a fit, we will see you soon. Thanks again. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.